So this week there are two main events. Firstly, the Bank of England. Secondly, the department store reporting in the US, where Macy's was particularly weak. We've seen a decent performance from the FTSE, helped by weaker sterling and also the energy sector, which performed well because of the oil price rebounding. In terms of the Bank of England, we saw a sort of status quo in terms of their announcements, basically saying that everything will be fine if we have a smooth Brexit. So they're trying not to make any sort of statement that can be construed as political. What they did say is they expect inflation to peak out at 2.8% by 2018, and we're starting to see productivity, or they're hoping productivity will start to pick up. So we won't get that wage growth coming through just yet, but with unemployment rate at 4.8%, with average hours going up in terms of average hours worked, and issues with recruitment, they do expect wage growth inflation to start to come through, and that chimes with our view that returns to capital start to diminish as the labour force takes a larger chunk of profitability as wages go up, and that chimes with what's been going on politically as well. Here you can see the inflation expectations that are baked into the market at the moment. You've seen Brexit has fueled a big rise in inflation expectations in the UK, although that's rolled over a little bit recently, and equally Trump and the big infrastructure rollout has also done that in the States. What you've seen is a sort of step back in that reflation trade, and we've seen the 10-year in the US go from 2.6 down to 2.2%. That started to rise again to 2.4% following the Fed statement last week. So we think that inflation trade is still on. In terms of reporting next week, we've got Vodafone, DCC, EasyJet, UK on Tuesday, Home Depot, TJX. On Wednesday, got British Land. On Thursday, Land Securities, National Grid. That's the main focus there. In terms of the retailers, as you can see here, annual percentage growth in terms of top line for the department stores has been negative for around 4 or 5 years now, and we're really seeing a capitulation in that sector. We've chosen to invest in those discounters, which you can see there, which have been above the line in terms of growth, managing to grow in this environment, and also the sports apparel stocks, which again have grown. More recently, we've seen a little bit of a pullback in that area because mall traffic has been particularly poor, but some of that is expected to be around tax rebate issues, which are special situations for this quarter. Looking at TJX, we can see what an incredible growth profile this business has had. In terms of each year, we've seen positive annual growth rates, and in pink we've got the periods of recession. So as you can see, they've grown extremely strongly in those recessions, with just one down year in 1996. That's because of the business model. When high-end retailers are struggling, they look to put their stock through different distribution channels. TJX stock improves, they get more customers, they get more sales. But it is a structural story here, and we are seeing a big change that's affecting other industries as well. And that was highlighted in the Starbucks conference call last week, where they said more retail stores have closed in the first quarter of calendar year 2017 than closed in the whole of 16, and they expect more retail stores to close in the US during this year than they did during any year following the Great Recession began in 2008. So that's a very negative story, and that has implications for rents. So as we go into the results next week, British Land and Land Securities, we can see that these have now, the listed REITs are now sitting at a pretty big discount because of their legacy portfolio of property. With Land Securities now and British Land at discounts to NAV of around 20 to 35%, and with that fall in sterling for foreign buyers, they're now significant discounts to where they were pre-Brexit. That may seem strange because all the transactions that occurred since Brexit have been done at premiums to Brexit NAVs, and you've seen some good news flow for particularly London, where Facebook, Apple, Google, Snap, ASOS have all come in and increased their European headquarters in London. But we will be looking for a better steer in terms of how gloomy they are about the outlook. Certainly there is a pretty negative scenario baked into those prices. The alternative in the property sector has been the likes of big box retail and London Metric, which are supporting the online distribution business. They are sitting at quite significant premiums to NAVs, around between 15 and 17%, as people see the expansion in UK retail sales at around 88% and the additional square footage in terms of logistics that's needed to fulfill that. Both of these sectors demonstrate the importance of getting your medium-term outlook in terms of structural stories correct. That's it from me. Thanks very much.